Hello all. Hi there. How are you? Welcome to yet another edition of the Healthy and Wealthy Mind. My name once again is Andrew. And today we are going to talk about the assets, investment in assets being safer than keeping cash in the bank. Don't forget to like, share, and subscribe to my channel. Comment and I'll reply to your comment. Now, as you know, time is the best asset. And that means if you're to invest in assets, time being the best asset, you need to invest between a certain age and a certain time frame. Let's say 30 to 50 years. This is the best time for investment because this time you have more time to acquire more skills, learn new business connections, learn new business knowledge, and you have enough time to grow business in order to have enough cash flow for your retirement stash fund and to have enough cash flow to gain passive income and profit to save to your bank. Now, why do we need to invest in assets? So that we can make it safer than investing in cash or keeping cash in the bank. One of the reasons, let's start by looking at savings in the bank. I don't say savings is not good. Savings is very good. But savings in the bank will attract an interest per annum, let's say 2% to maximum 7%, especially for example in my country, Uganda. 2 to 7 to 8% interest per annum is way little than investing in short-term assets using the same amount of money you're keeping in the bank. What do I mean by the short-term assets? Let's look at the unit trusts. Let's look at the treasury bonds. You can invest in these short-term assets. You generate passive income of which the profit can be, a portion can be saved in the bank as savings. So savings is good, but savings is only safe parking of your cash into the bank, getting a certain interest, which is like 2 to 3% to 5%, mention it. But the safe parking of your cash, you're earning a small interest, but you're not having value for your cash in the real times. What do I mean? When you keep money in the bank, that means the interest you get cannot be compared to the same amount of money that you invested, for example, in a short-term asset, which is a treasury bond. Treasury bond will attract a higher interest. Let's say if you take a 10 to 20-year bond, you will attract an interest of around 16%, and of which the interest of 16% is paid per annum. You're getting 1, passive income. 2, you're keeping your money safe because this short-term investment can be easily liquidated back to cash at any time when you need it. You just need to sell off the short-term investment. Secondly, when you keep money in the bank, you're saving. It's always advisable, save a particular amount of money to cater for the short-term needs. Let's say ranging from paying the rents, paying the school fees, short-term activities that you need to finance. You need to buy something on the short-term basis, save a particular portion of money. Then where do you put the rest of the money? The rest of the money, invest it in the short-term and the long-term assets. This will ensure 1, it will ensure you a cash flow. 2, it will enable you to stash a particular amount of money for your retirement fund. As we said, time is the best asset. That means you need to use this time between the ages of 30 to 50 before nature kicks in. So, if you have salary, earnings, or you're still in employment, the best thing to do is to have a particular portion of your income generated from your salary between these ages and invest it. The other portion of your salary, keep it as saving to cater for any urgent needs. That means you will have a passive income being generated from the business or from the investment you made in the short term or the long term, while also you're having enough money to run you through, such that you don't get more money from your investment over time. That means it will keep you avoiding to save back your cash, because saving is good, but then it's like you're just drilling a hole in your pocket. The money is there, you're keeping it, but it's not generating more income. Let's look at the long-term investments. We have long-term investment, for example, land. In every facility we need to do, we need land, right from the infrastructure, construction of the factories, the manufacturing plants, all this you need land. Real estate, all this you need land. But remember, when you invest in this long-term asset, you're getting 3 benefits. 1, you're gaining a passive income. 2, the land is appreciating in value. As you know, land appreciates in value on statistics, because information is there. On statistics, maybe 20 to 30%. That means where you invested, for example, $10,000 in a year, this land, if it appreciates between 20 to 30%, that means you're earning an extra $3,000 to $3,500 per annum. This is the appreciation value for your piece of land. You cannot compare this appreciation value to the savings in the bank. 2, that is the second one. The third benefit is, other than getting the passive income and getting the appreciation value, you have these investments that can be liquidated at any time. At any time, whenever you need cash, you can always liquidate these assets at a higher price. But when you come to the savings, the money you keep in the bank, quote me right, savings is good to cater for the short-term investment. But let's look at inflation. What do we mean by inflation? This is the rate at which prices increase over a given period of time. When you save money in the bank and prices are increasing day by day, as you know now the economy is not doing so well, that means the inflation rate is very high. So inflation rate is very high. The person who bought an asset 5 years ago, after these 5 years, and the person who saved money 5 years ago, which one is better than the other? This side, the person who invested, and this side, the person who saved the money in the bank. So if you invest 5 years ago, due to the inflation rate, the money you saved, let's say $10,000 at a dollar rate of 3,650 in Uganda, or 3.65, around there, and the dollar rate goes down, but the prices, the money you have in the bank, once you change it, also its value will go down. But the person who bought the asset 5 years ago, or who invested 5 years ago in the assets, even there is inflation, the value already has appreciated. The same money you used to buy this same piece of land or real estate will not be the same money you will need to buy it after 5 years. I'll give an example. If you buy a house, or if you buy a big piece of land at $10,000 5 years ago, after the next 5 years, due to the increase in prices, you will find the price has increased either more than 50% of the original price 5 years ago. This one you can testify, because you know it's true. So it's always safer to invest in the assets. Short-term assets like treasury bills, treasury bonds, unit trusts, or long-term assets like PPE, which we look at property, plant and equipment. So you can invest in real estate, you can invest in production, Inventories. Inventories, what do I mean by inventories? Let's look at raw materials, work in progress, and the finished goods. All this inventory is very crucial for the long-term investment. For example, I'll give an example. We have very many stone quarries, for example, in my country, in Uganda. Very many people are mining the stones. These stones are used for a number of purposes, right from construction of the infrastructure like roads, construction of houses, construction of different things. So, if you invest in these raw materials, if you invest in the work in progress, you will have to reap benefits every year, and every year the value is appreciating. So, keep money in the bank, a small portion, and invest more, because investment is risky, but the higher the risk, the higher the returns. And don't fear to fail. Whenever you do an investment due to the risk, there are chances of failure, but failure is part of success. Failure is part of success. So always expect that an investment can fail, but always you need to be moving. You need to invest. And this is how you cater for your retirement/fund. So you need to ensure that after 50, or whenever nature starts to kick in, that you have enough cash flow. The worst thing is to reach the time of retirement and you don't have cash flow. But how do you create this cash flow? From investing into the assets, short-term and the long-term assets, as I've differentiated them. Short-term assets, right from the treasury bonds, unit trusts. Long-term assets, the PPE, investing in the land, investing in property, different property. So, in conclusion, I still insist and still advise how assets will make you rich, wealthy, and also ensure that you have a cash flow during the retirement. Because when you invest in these assets, they will generate the passive income, they will generate for you the appreciation value in the asset, and this appreciation value you get and the passive income you get, this is the money that you can save back in the bank as cash to earn the small interest rate. Thereby, in conclusion, see that you invest in alternative sources. Diversify. If you invested in the short term, also invest in the long term and maintain a certain portion as savings. Secondly, do not fear to risk, because the higher the risk, the higher the return. And thirdly, failure is part of success. Always ensure you're investing more money in the assets. As we've discussed about the assets, this will ensure that you have enough cash flow to cater for your retirement. You stash enough money to cater for your retirement, because when you have the asset, your asset rich at 60, but you don't have any cash flow, that means you need to invest in assets that are also generating the cash flow, the passive income. And that's why we talk about the treasury bills, treasury bonds, the government gold reserves, land, real estate, because all this will generate for you the passive income, and they will also appreciate in value, that in case you need to have a cash flow or to invest more to boost the business. Because I will not advise you to start a business, let's say at 60. It's possible you can start the business, but when you start the business at the time 30 to 50, when you still have the energy, you have the zeal, you still have the skills, the knowledge and the connections and everything, when you reach time for retirement, you just liquidate some of the short-term assets and you further boost the investment. Hope you liked my video. Hope you learned something. Investing in assets is more safer than having a lot of cash in the bank. Though, save some cash in the bank to cater for the day-to-day small needs, as we discussed at the beginning of the video. Thank you so much. Keep it locked. Cheers.